Hello again, Bob Wazorek on fixed income. We're still on module 5 and this is segment 7. Segment 7, we're going to be talking about asset-backed securities, mortgage-backed securities in particular, and just touch briefly upon some other types of asset-backed securities. So why do we need to know this? Well, the mortgage-backed security market is the largest part of the credit market, meaning the non-risk-free sovereign debt market, and we need to get comfortable that, as it's the largest part of the bond market, credit bond market, that mortgage-backed security, or MBS, is not a bad word. As soon as we understand it, I think we can get comfortable with it. So we're going to look at how these mortgages are sold or converted into securities, the general structure of mortgage-backed securities, and then we're also going to get into asset backs and how we can tranche out debt, or basically match risk profiles and return requirements to meet investors' needs. So let's get started. Okay, mortgage-backed securities. Okay, basically all this means is that it is a security backed by a mortgage. Okay, generally these are residential mortgages. It could be a commercial mortgage, so those would be commercial mortgage-backed securities. Generally, so we would have the modifier or qualifier that's either residential or that it's commercial. Okay, we're going to be focusing on or talking about the residential side. And the residential side, you generally have potentially 3 different entities that are either buying those mortgages or placing their guarantee on those mortgages. And that's the Government National Mortgage Association. This one is more commonly known as Ginnie Mae. And then you have the Federal Home Loan Mortgage Corporation, more commonly known as Freddie Mac. And then you have the Federal National Mortgage Association, or Fannie Mae. So those are the 3 main entities. The first one, Ginnie Mae, is a government agency. The other 2 are what we call government-sponsored entities, and these are the last 2 are the ones that actually got into some financial trouble during the financial crisis and ended up being taken over by the federal government and being run by the federal government. So at this point, all 3 of them are effectively directly related to the U.S. government. Just because these are the main ones, prior to the financial crisis, you also saw many non-government related pass-throughs. I'll explain what pass-through means in a moment. And that basically is where banks were going out and issuing mortgage-backed securities themselves. Right now, the market seems to be more focused on the government-backed mortgage-backed securities. So let's take a look at how we do this. Okay, the simplest mortgage-backed security structure is what we call a pass-through. Okay, a pass-through is where we take the individual mortgages, and so payments start coming in from those individual mortgages, and those mortgages that we've now pulled together go into the pooling agency, or this would be the servicing institution. Okay, bear in mind, okay, when we have a mortgage, we have to pay that mortgage to somebody, we have to mail the check to somebody. Well, that's a servicing institution. Okay, the servicing institution then passes through, as the name suggests, those payments directly on to investors. Okay, the only sort of difference between the money in and the money out is the servicing institution takes a fee for providing this service, this collection service, in corresponding with you, the borrower. But then that's it. They directly pass through whatever payments are made. So if somebody makes an extra payment, that gets directly passed through. If somebody misses a payment, well, then that also affects the cash flows that are passed through to the holders of these securities. So it's a very transparent process where the investor basically directly feels the cash flow profile of those underlying mortgages. So for better or worse, acceleration or deceleration of payments gets directly passed through to those investors. There's no filter other than the fee that the servicer takes for providing the service. Okay. As a result, because people have the tendency to prepay their mortgages and can prepay at any time, we don't necessarily know when we're going to get our principal back. Generally, it's on an accelerated basis, more accelerated. So if it's a 30-year mortgage, most 30-year mortgages are repaid within 6, 7, 8 years. They're repaid. So you do expect prepayments, but how much or how large those prepayments will be will vary from pool to pool and vary depending on the interest rate environment that we're in. Okay. Okay, now these mortgage-backed securities, we can also look at sort of a broader segment of asset-backed securities where we call them ABS. Okay, an asset-backed security is really just a catch-all for any type of asset that we put behind this security. So a mortgage is one type, but it could also be credit card receivables, could be auto loans, could be student loans. Here we have collateralized debt obligations. We could also have CLOs, which would be collateralized loan obligations. Then we have CBOs, which would be collateralized bond obligations. So basically, if Wall Street can dream it up, we can make it. So there's quite a bit of flexibility in these products. Wall Street had been quite innovative prior to the financial crisis, and I think coming out the backside of the financial crisis, the trend is to more simplistic or straightforward securities with that are easier to understand. But let's take a look at a typical tranching structure for an asset-backed security. Okay, well, here's the situation. So we have a lender, a bank, who goes out and makes a bunch of loans. Okay, here it says they're bonds. They could be bonds, they could be loans, they could be mortgages. Okay, they could be pretty much any financial asset. Well, we put together this pool of assets, and this is the pool of assets that we have, and our rating agency comes back to us and says it's A-rated. Well, that's fine, but then when we go to our salespeople and try and sell these securities, we find out that there is a relatively small appetite for A-rated securities, and that there's a larger appetite for AAA-rated securities. So what we want to do is we want to somehow take our A-rated securities and reorganize them such that we have AAA securities and AA securities that we can sell to the fixed income market. So how do we do this? Well, the process is what we call tranching, and we tranche out the debt. And basically what we do is we're creating a synthetic capital structure or a priority or order of repayment within our bond offering. So basically what we do is we describe people as the first loss. So here's the first loss piece. Okay, and then after that tranche is what we call exhausted, meaning that the losses have wiped out that tranche. Then they attach, and again the terminology is attach, to the second loss. So this is first loss, second loss, and then third loss. So what happens is that each subsequent tranche doesn't get attached until the prior tranche is exhausted or has absorbed all those losses. So the whole idea is that if I have these more junior subordinate tranches to me, I can have lower risk or an enhanced credit rating by being more senior in this synthetic capital structure. And this way I'm able to take A-rated debt here and enhance it so that it ends up being AAA out the back end. And that is presumably what investors are demanding, that appetite is for AAA risk, or we can create that through tranching out our portfolio. Now, what also sometimes happens is that this first loss piece here ends up being pretty risky. That if this is a diversified portfolio, well, the chances are of somebody defaulting within our diversified portfolio are actually pretty good. So there are likely to be some losses absorbed by this first tranche. That makes this tranche, or what is referred to sometimes as the equity tranche, potentially difficult to sell. So in that case, not uncommon for that first tranche or that equity tranche to be retained by the originator. So the originator just simply holds on to that opposed to selling that into the marketplace. Okay, to recap. Okay, so mortgage-backed securities, largest part of the credit market. Okay, so these are securities backed by mortgages. They could be either residential or commercial. Okay, we spent most of our talking about residential mortgage-backed securities. Okay, mortgage-backed securities are not a bad word. Okay, it's a relatively safe investment. Why? Because not only do we have recourse to this individual and the cash flow associated with that individual, but should that individual default or have an interruption of their cash flow, basically lose their job, well, we have a secondary source of repayment in the form of the real estate that is collateralizing those loans. We also talked about how we can use other assets other than mortgages, where we could use student loans, we could use credit card receivables, we could use auto loans, bonds, bank loans, pretty much any financial asset we can use to back a security, and that would be an asset-backed security. And we also showed how we could tranche out that security to get different risk and return profiles based on what our investors were demanding. Again, this is Bob Wozorek. That concludes our 7th module. I look forward to seeing you on the next module.